Hello, and welcome back to yet another live event where we unpack multifamily investing and underwriting one step at a time. Underwriting under microscope and why closing costs and exit assumptions matter is the topic I will dive into today during today's pop up live. But before we get started, for those who may be tuning in for the first time, or perhaps for those who don't know me or haven't met me yet, my name is Vessi Kapulian, former commercial lender turned real estate investor. And today I work with high achieving professionals and high net worth individuals in primarily two ways. When it comes to investing, I help connect them to well vetted cash flowing opportunities, investment opportunities in apartments. And when it comes to consulting, I work with retail investors in terms of advising them and helping them navigate through the complexities of the offering and the underwriting, as well as I work with family offices and family enterprises to further advise them on strategic initiatives, investments, risk mitigation, governance structures, and so forth. But without further ado, what inspired today's topic, I actually want to give credit to an article that I came across not too long ago. It was published by the Altus Group, and it pertained exactly to the topic inside CRE valuation, why calculating US selling cost is not one size fits all. And by the way, if you'd like a copy of the article or a link to it, I'm more than happy to share. But this triggered an important question that I sometimes come across when I evaluate deals in terms of, are the exit assumptions realistic? And I've spoken at length about one of the key exit assumptions, namely cap rate, and that is definitely not to be ignored. I even had a separate live event and a ton of content around the topic. So if you're curious about it and would like the links, send me a DM or comment below, and I'll make sure you get it. So I don't want to regurgitate a topic that I've previously covered in great detail, but I do want to speak to a couple of the key points that the article addressed, which I think are very relevant to the underwriting process and that I often see missed or overlooked, or an area that where investors don't ask sufficient questions. And namely that oftentimes when you use an underwriting model, especially if you're market agnostic and evaluating deals in a variety of asset classes, variety of markets, oftentimes these models come pre-built with certain set of assumptions, but those assumptions are not a one size fit all when it comes to the particular deal or the particular structure, yet they can impact the overall return and the overall proceeds at the time of sale materially. Depending on the size of the deal, could be hundreds and thousands or even millions of dollars. There are a number of unique aspects of the deal, such as the property type, the property size, location, local regulations, and rules, particularly when it comes to transfer taxes, as well as the brokerage commissions, marketing expenses, legal fees, closing costs. All of that adds up. And typically, those projections are reflected as percent of the purchase price. So you can imagine the impact can have several zeros behind it when you start looking at the numbers. Um, for multifamily in particular, and again, the number really does vary based on the size of the property and based on the asset class. Oftentimes in multifamily underwriting models, you'll see anywhere from 1 to 2% being assumed, or 1% for exit fees, 1% for finance and other transactions, so adding up to 2%. And that's kind of the average, right? On the low end for multifamily, those fees have ranged anywhere from 190 on the high end to 20, but that's on average, and those numbers can really vary by market. So if for those, for example, following the LA real estate market, it wasn't too long ago. It was maybe about a year or 2 years at this point ago when the mansion tax was introduced. That impacts the transfer taxes at the time of sale for properties that are 5 million and above. And so in today's market, that transfer tax could be anywhere 595, 6, depending again on the size. There are different tiers of the property. And so if you're underwriting with the national average or the pre-built templates in the model assumption of 2%, you will be in for a very, very nasty surprise, right? That 4% differential, when taken as percent of a purchase price, that's millions of dollars, can have a profound impact, not only in terms of the dollars, net proceeds from the time of sale, but naturally that also impacts your projected returns. And again, depending on the jurisdiction, those transfer taxes could be sub 1%, they could be 1%, they could be higher. So it's really important to take those into considerations. One of the reasons why I really appreciate and value working with operators who focus on a market, because knowing those unique market aspects, right, will help you fine tune the numbers as you make projections and evaluate the exit at the time of sale. Another variable that I often see overlooked are prepayment penalties. Of course, you could buy, right, for the flexibility of more either a step down structure or perhaps waiving the prepayment penalties, or waiting them after a certain point of time, maybe after 4 years or 3 years versus 5. So there are ways to build in flexibility that is not free. So you do pay for that up front, and it's taken into consideration when pricing the loan. But to the extent you haven't, the operator hasn't opted to pay for any flexibility, and they have, say, a 10-year loan. I sometimes actually see that, surprisingly. They have a 10-year loan, and their business plan is, say, 5 years, but they want to have that additional flexibility. And when I look at the underwriting model, I don't see that prepayment penalty factored in, of course, after verifying that they haven't negotiated any concessions or paid for any flexibility. And again, that could be a couple 100,000, or depending on the size of the property or the project, could be even millions of dollars that needs to be factored in. I was hoping I can share a spreadsheet of a sample deal with you, but for some reason the screen share is not popping up on my screen. But I'm happy to share the visual of the example. There was on a live deal that I had looked at, and for that particular deal, the projected returns net to LP for a 5-year hold deal was 15% IRR, and that again assumed a 1% exit fee based on the peculiarities of that market. But if it happens to be a market where there are additional transaction costs, such as with some of the examples I just verbally shared, and let's just say the transfer taxes, commission, title, legal, all of that is all in 4%, then the profile of the deal, that changes to 14% IRR. So just that one assumption alone, right, can have a material impact on the overall return profile, which is then, of course, driven by the net sale proceeds, which are impacted by those exit assumptions that I feel are often overlooked. So that's it for today's brief pop-up. I know the holidays are near, with Thanksgiving upon us later this week, so I've changed the schedule a little bit to keep my commitment to you and continue delivering insights bit by bit on a weekly basis. And in light of the holidays, in case you missed the message, I do want to make you aware of a special offer that I am extending only during the Thanksgiving holiday, and that's for 50% off to join the Mastering Multifamily Underwriting self-paced course, which is on demand and meets you where you are. And that comes effectively with a free 1 year access to the community where we interact outside of the course, meet monthly. I'm in the hot seat answering questions and so forth, which relationships are built, partnerships are formed. So if you're curious and want to learn more about it, feel free to send me a DM. I will also post the link to the limited time promotion so you can take advantage of it if you choose to. And since I won't see you until next week, I wish you a very happy, peaceful, joyful Thanksgiving. And we'll see each other next week during the regular pop up live event. Ciao.